Patricia paid off her mortgage at 52. No debt, no payments, full ownership. This is supposed to be the finish line, the dream, right? But just a few months later, her air conditioner failed. The quote to replace it came back at $11,000, and she couldn't afford it without borrowing money. That sounds impossible. How can someone who owns their home outright, a major asset, feel financially trapped? It's because in Canada, the conventional wisdom about paying off your mortgage can quietly remove the one thing emergencies always require: liquidity, cash you can actually use. This isn't a story about bad decisions. It's about a financial blind spot that affects millions of Canadian homeowners. Today, we're going to talk about why rushing to be mortgage-free might be one of the biggest financial risks you can take. This situation has a name. It's called the equity trap. Think about it. Now, equity feels safe. It looks great on paper. Your net worth goes up. Feels like you're building a fortress of financial security. But here's the problem. That fortress has no doors. Equity cannot pay a bill without significant friction. You have to apply for a loan, get approved, and pay fees and interest. The moment Patricia needed that $11,000 for her air conditioner, all that wealth locked in her house stopped being useful. Her net worth was high, but her bank account was not. She was house rich and cash poor, trapped by the very asset she worked so hard to secure. Let's talk numbers, because this is where the real cost becomes clear. Patricia rushed to eliminate a mortgage with a 4.5% interest rate. Over 15 years, she made aggressive extra payments, and she definitely saved a lot of money on interest. That feels like a clear win. But what about the alternative? What if that same cash wasn't used to pay down her mortgage faster? What if it was invested conservatively inside a TFSA, a tax-free savings account? Historically, a balanced, conservative investment portfolio compounds much faster than the 4.5% she was saving. The opportunity cost, the growth she missed out on, is staggering. She didn't lose money in the traditional sense. This isn't about blaming her. It's about understanding the hidden trade-offs we all face. This brings us to a critical concept: liquidity. That's the wrong way to look at it. Cash isn't idle. Cash is insurance. Liquidity is what absorbs financial shocks. When an unexpected emergency happens, job loss, a medical issue. A major home repair, liquidity is what protects your long-term investments from being sold at the worst possible time. Patricia had plenty of equity. What she really needed was access. She needed liquid cash that she could deploy immediately without asking a bank for permission. Now, I know what many of you are thinking. The bankers and mortgage brokers always have the same answer. Don't worry, if you need money, just get a HELOC. First, you have to qualify for it, which isn't guaranteed. In Patricia's case, she paid off a 4.5% mortgage, only to be offered a loan against her own house at over 7%. Think about that. You are borrowing your own money back from the bank at a higher interest rate. A HELOC is a tool, but it's a reactive tool, not a proactive solution. It's a financial band-aid, not a cure. The real goal is optionality. It's about having choices. It's a balanced financial structure, one that includes a strategic mortgage, healthy liquid reserves. An invested capital will almost always outperform a paid-off house when it comes to true financial resilience. Your investments provide the growth and flexibility to fund your future. Your liquidity provides the time and safety to navigate the unexpected, and your mortgage. It's a tool that allows you to keep more of your own capital working for you. Together, these three elements protect you from being trapped. They ensure your wealth remains useful. Okay, let's make this practical. What does this look like in action? Here is a simple 4-step Canadian escape plan to avoid the equity trap. Step 1. Keep a strategic mortgage. Don't rush to pay it off, especially if the interest rate is relatively low. Think of it as cheap leverage that frees up your personal capital for better uses. Step 2. Build liquidity outside of your home. This means establishing a robust emergency fund and a high-interest savings account. This is your shock absorber. It should cover several months of living expenses. Step 3. Invest your surplus capital. Once your emergency fund is solid, direct any extra cash into your TFSA or RRSP. Focus on long-term diversified investments that are aligned with your risk tolerance. This is your growth engine. Step 4. Let the system work. Allow your investments to compound and grow over time, while your mortgage naturally amortizes with your regular payments. You are simultaneously building wealth in the market and equity in your home, but without sacrificing your financial flexibility. This isn't about taking on reckless risk. It's about being smarter with the resources you have. That is true financial freedom. Thanks for watching. If this helped you see your finances in a new light, consider subscribing for more content on building real, usable wealth. See you in the next video.